The man who is the group managing director of Afrinvest West Africa is live here in the studios with us. Ike Chioke, good morning.
Good morning.
It's good to have you here, sir.
Thank
we
you.
appreciate your time. It's been an interesting first 6 months of the year. So as an investment banker, a chartered broker, or securities market individual, put the macroeconomic environment of the first 6 months together for us and how that had actually impacted on the various asset classes and the markets.
Interesting time. I think what we've seen is that the economy is improving. We saw a contraction of as much as 1.2% by Q4 2016. We've seen a decline in the contraction as Q1 2017, only 0.5%. And we expect that the improvement can continue so that by mid-year, by the time the June numbers come out, we should see some kind of positive trajectory.
Very quickly, because of time, what did the fiscal authorities and perhaps the monetary authorities together got right in the first quarter, or was it part of the spillover of 2016?
Wasn't so much. There are some other fundamental changes. You see that back in 2016, we had a Niger Delta militancy issue, so that contracted our oil production volumes to about 1.6 million barrels per day, in addition to the low oil price environment. Now we've inched up to between 1.8 to 2 million barrels per day. That's helped, and that accretion, that increase has also led to the accretion you've seen in the external reserves, which has gone up from $26 billion as at end of the year 2016 to $30 billion at half year 2017. With that, the central bank has then become sort of more constructive in managing the foreign exchange environment. You saw the introduction of the investors and exporters window in April. That again itself, created a sort of more transparent platform for investors and exporters to exchange currency, and that has also buoyed the market. We saw about $3.8 billion as exchange in that market alone. Although the CBN hasn't really done what we expect them to do, which is a full convergence of the currency, we still have something like 6 to 7 different official rates from the,
the IOC's window.
The IOC window for import of PMS to the central bank official rate, the interbank rate, the NAFEX rate, the Form M and Form A people. And there's probably going to be a rate for, people going on Hajj, which is coming up soon. So this is not helpful to the economy. I think that, if we move towards an environment of full convergence, that will again be another signal of, positive adjustment of the economy to sort of real market prices. So all of that has been beneficial. With the introduction of the I&E window in April, the market has surged. If you recall, as of March, the market, the NSE All Share Index was down minus 8.5% to the year. It's now up 23% year to date. That's a positive swing of over 31%. In fact, at a point it was up 25%. There's been some profit taking, but that has come back. And we expect to see more sort of people are thinking, oh gosh, has all the upside gone out of the market? I don't think so. Our belief is that as the half-year numbers begin to come out, we expect to see more fundamental results coming, and investors should be able to pick based on fundamentals. The best performing sectors still remain agriculture, which is up 65% year to date, banking 45%, industrial sectors about 21%. So there's still some choice stocks to pick within those universe.
In terms of economic fundamentals, and this is bringing me to the question when people say, look, it looks like we're all tied to the apron of oil, whether in terms of production or in terms of price. But if we can discount this too and say, are we on serious macroeconomic fundamentals in terms of policies and policy actions, what would you say?
Well, to be honest, we have good plans. We're not very good in implementing anything. That's really the problem. I think where the central bank is quite close to sort of being able to sort of make a full adjustment on the currency side. Given where the oil prices are internationally and given where the exchange rate is, I believe the subsidy on oil, on PMS is quite low. This is a great time for the government to consider removing the subsidy fully. That will also signal to real investors that they can come in and invest in the downstream side, which is something we've been arguing for years. So there are certain opportunities that are staring us in the face, which we are reluctant to take, either for non sort of monetary or fiscal policy reasons. There are also political, persuasions behind the scenes. So it's unfortunate that this is the case, but quite frankly, there's a time that you could say the country could be ready to start moving away from oil, but we do need to make certain critical reforms for that to start happening.
There are critical decisions to be taken. So let's put this to you straight. What do you consider today the fiscal position of the Buhari's administration? From the debt sustainability side of things, from borrowings, external and domestic borrowings, the debt servicing, these are serious variables that would have very serious consequences.
Well, you're really, going towards the end where a corner which is really not a good point for the current government. You see, the 2016 budget was 6.1 trillion with a deficit built into it of 1.8 trillion naira. Now, they fell short of their own revenue target by about 18%, so they had to borrow more. Now, the 2017 budget is even more aggressive. It's a 7.4 trillion naira budget with a built-in deficit of 2.4 trillion naira. Now, the problem with that borrowing is that we're driving the country to a point where you will say that the debt is not sustainable. I mean, the DMO could argue that with only 15% debt to GDP, that Nigeria is not really that leveraged. But we have to look at it from the capacity to service the debt. In 2016, our debt service to revenue was 33%. In 2017, it's already trending to 66%. So that means for every 1 naira of revenue we make, we spend 66%, 6 kobo to service debt. That is not a sustainable direction to go. Clearly, the government is making efforts to increase and deepen tax revenue. There's a lot of reform coming out in the tax sector, but these will take some time before they trickle in. It may then be more sensible for the government to take a more conservative approach on the budget side by not taking a more, such a large deficit into the budget. And those are some of the constraints we'll see in the system, because by going to borrow, you see the government crowding out the real sector, and at the same time, interest rates are high, inflation is high, and then, of course, real companies cannot go and get money at a decent price. With FGM bonds, average yield about 16% now. If you as a corporate want to go and borrow, you have to put maybe 300-400 basis points on top of that. If you as an individual want to borrow, you're clearly in the north of 22, 23%. So that's quite expensive for, for the economy, for people to be able to get money, get liquidity.
From your C-suits position as an executive, you think we've got a bit of our fingers on the FX side of things.
Correct.
So at second half, the balance of 6 months of 2017, where we are now in the first month of that, what do you consider as the top risks elements for the good fortune that we've had in the first half?
The big risk factors remain oil prices and our own production volumes. We had always had a sort of special treatment at OPEC that allowed us to do as much as 2 or 2.2 million barrels per day. But there's current discussions about Nigeria being asked to reduce their own production to be in line with our allocation within the OPEC system. So clearly, we need all the production capacity we can get. So that's a risk factor that has not yet crystallized yet. There is inflation. Although inflation has ameliorated, from about 18% at the beginning of the year, is now about 16%. That's only reduced due to the base effect, because the inflation numbers were much higher last year. But we don't see that coming down. We're projecting maybe by the end of the year it could become to around 14 to 15%. But already we're seeing that food price inflation is trending upwards. It's a seasonal effect. And if that's not checked, it could mean that inflation could actually trend upwards by the end of the year. I
have interesting discussions with Group CEO of Afrinvest West Africa, Ike Chioke. Thanks for still being here. We're talking about banks. Skybank, so let's hit you with this. This morning issued this statement about a recapitalization proposal being considered by the central bank and all of that. The financial statement for 2016 still not yet out. Talk us through the Tier 2 listed banks. Do you think there's a cause for worry?
No, I think it's a positive signal for Skybank. Skybank, as you know, has had a few challenges, and I think their biggest problem might have been the way they did the acquisition of Main Street Bank back in 2015. 2014, 2015. Afrinvest, as you know, was actually in the driving seat of that transaction, having acted for Amcon on the sale. And then the Skybank at the time paid 126 billion naira to acquire Main Street Bank. That was quite eye-popping for them, because when you looked at their balance sheet at the time, you asked yourself, how could they have afforded, such a large sum for another bank? Although their own advisors must have, had approaches on how they would have settled their financing arrangements. But immediately after that decision, now you come into a recessionary environment and a contraction in the economy. That was something they hadn't planned for, and that probably put severe strains on the balance sheet of the bank. And then Tokunbo and the new management, Tokunbo Abiru, came in middle of last year. I think they've done a sterling job in pulling the bank together, and this announcement this morning is probably positive for the sector, and particularly for mid-tier banks, which are always the ones to watch, if there's going to be a problem in the banking sector.
Yes, well, because Afrinvest, your organization, always come up with a very hefty annual banking sector report. So yes. I was just going to get you to talk a little bit about what's in the next report that you're thinking of.
The next report we're thinking about, is, are we out of the woods? Because we've had this recessionary environment we've been through 2015 to 2016 into 2017. And now people coming out of it and saying, which way now for the economy, which way for the banking sector. We haven't actually honed down on the title, although we are almost done with the report. This year we decided to do something more interesting. We intend to launch it in London in partnership with the London Stock Exchange. So that's going to be part of our rationale for doing that is also to signal on an international platform that Nigeria has reopened for business. We believe the signs we see in the economy are positive. We expect to see more constructive developments in the economy from the policy managers, both at the Central Bank and the Ministry of Finance, and of course at the Presidency. And on the back of that, we think that it's an appropriate time to have the launch of the banking sector done in an international platform, so that international investors can get to see firsthand and understand, the dynamics of the Nigerian banking system and the economy. Because
if they're going to come into the Nigerian environment, the banks are usually at the reception desk.
Absolutely, yes. Banks, most investors will start with the macro first, and then they look at the banks before they then begin to look at whether they want to be in consumer sector or agri sector, because the banks really act as a toll gate to the economy, so to speak.
We appreciate that. Thank you very much. So with the London Stock Exchange, the next banking report, that's taking all the 25 banks to London.
Thank you.
Thank you.
It's a pleasure.
I'll see you then. Ike Chioke, Group Managing Director at Afrinvest West Africa.